what deal structure might look like.
And what types of metrics are most important?
What are we doing as a company and where are we headed?
What are benchmarks within that market?
What is the range of values of my business and where am I today? Where do I want to go?
What type of multiples they're using and what are the key metrics they're looking for?
QuietLight can help you value that business. And the real first step is get in touch with John and have a conversation about where do you fit in the market yourself individually.
Hey everyone, I'm Sam from QuietLight. I've got one of our senior advisors, John Hainstock, with me today, and Tom Buchok, who is an advisor for SaaS companies, and they are going to talk all about the state of the SaaS market. Lots of great learnings. I will hand it over to them. Thanks, guys, for joining.
John and I are together today because we thought it'd be good to share some of the stuff that the team at QuietLight and John specifically is seeing out in market. And then I work with independent SaaS companies for them to grow to hit their goals. And how we do that is by kind of starting out and saying, what's the market look like and how does that compare? And what QuietLight offers is the ability for us to kind of understand, what's the state of the market. And so as we go through today, I think what John and their team over there sees and has access to is really interesting. Both John and I come at this from a place of having started and operated and eventually exited software businesses. I think that anybody who's looking for an exit in the 1 to 5 million, we're here to talk to you today and provide you with some ideas and thoughts on what's going on in the market and how to run your business successfully to hit that dream exit or keep growing and keep running the business that you want to run.
Yeah, exactly. Yeah, it'd be cool I'll share a little bit about my background too. And then Tom, maybe you can share about how your exit process went. And this is not going to be a long bio here or anything like that, but I just share from my perspective. When I sold my SaaS business, it was not something I prepared for personally. It was something that kind of came out of the blue. And so I think from my perspective now is to try to help people prepare for that, usually 6 months to a year in advance, potentially longer, and to think with the exit in mind and prepare backwards and just have the conversations that I was kind of rushed through, and the decision process I was rushed through due to the way that the sale came about, which was the buyer reached out to us and we weren't quite ready to sell. And we went through another year and then it kind of somehow surprised us again. And when they came back to us again. So that's kind of my background, my experience. Definitely been in the trenches of operating every single day in the B2B SaaS world. So that's my perspective. And now just being able to work with other SaaS founders, primarily bootstrap SaaS founders or lightly funded SaaS founders, is just a joy. And I love to be able to kind of work through how buyers are most likely going to perceive their business, what they can do to maximize their valuation, their exit, and all that stuff. So, but Tom, your experience was, I think, a little bit similar in that I think you had some direct outreach, but would love to hear a little bit about that too.
I also I loved my personal journey. I really enjoyed running my business and everything that entailed. And then one day we got interest. There's always kind of, if anybody listening, sometimes we get interest and we might get a cold email here and it's hard to parse out what's real and what's not. Be cordial but respond and not distract yourself from the operating the business. But like you, John, his inquiry ended up becoming something material and ended with me and selling my company. That wasn't my objective. I tell people that if your backup option is that you're happy running your business, it provides you with a lot of clarity. And I don't think any big process, whether it's buying a home or selling a company, I think that is overwhelming and there's lots of new things to learn, that we're feeling comfortable with our business and it's not in some distressed state. That gives us, even if somebody comes around and asks to buy it, we're in a pretty good negotiating position. I work with companies that want to put themselves in the best position to grow it themselves, to potentially, and all the while enjoy running it. So what I like to say is I don't focus on the income of your business. I focus on the value of it. What that means, it's really the same things when we're thinking about potentially selling our business and or just running it. We still want to focus on the kind of the intangible values and the things that make it, give us that higher multiple. And we'll talk a bit about that today and how that relates to the state of the market, valuations at any given point in time. We can really kind of pinpoint and set our compass to good, clean operations and strategic focus. And that gives us the best chance to succeed as business owners at any time. It's kind of agnostic to time and place and business conditions.
Yeah, that's what I'm really interested to hear you chat about more, Tom, is actually the operational side of things and what made it a business that you enjoyed running on a day-to-day perspective. I think we've discussed this offline a little bit about your team and some of the things that you were doing on that side, and just how that affected how the business was perceived by buyers. So we'd love to hear a little bit about your philosophy around that and some of the things that worked for you, just to kind of give somebody a picture if they're maybe solo founders or they have a very small team and they're starting to build around themselves, build up and delegate. Like, this is, I think, a great time to hear what Tom has to say about that.
That's where also knowing what's going on in market from you, John, is we can say like, well, here's how things work, and you can say, oh, this is how it impacts. So as we dive in, the most important thing, Quiet Light and John specifically are able to have detailed conversations. Every business is going to be valued differently for all of the variety of permutations of what's happening in operations, your business model, your relationships with your customers, product market fit, some of the metrics that we talk about in SaaS in terms of revenue and MRR and churn. Quiet Light can help you value that business. And the most important thing that I feel in working with my clients is, do we know the value of our business and where we fall in that range of valuations? Anyone listening, get in touch with John, see about a business valuation, no strings attached. That provides a North Star, a guiding light for any planning that you may want to do, whether that's thinking about selling your company, deciding you want to grow it, or anything in between. And so as we go through this material today, the real first step is get in touch with John and have a conversation about where do you fit in the market yourself individually. So we're going to talk kind of broad strokes, take it to the next level, and get that conversation with John to just get a high level overview of the value of your business today.
Yeah, appreciate that. I mean, what I'd love to dig into there is, beyond the valuation, though, just from your perspective, what was meaningful to the buyers when it came to the strategic moves that you had made, not necessarily for an exit purpose. You just wanted to build a valuable business. You wanted to build a good business. And so I think that would be interesting to hear, is from your perspective, what are some of those things that you would share with other founders who are, they might never want to sell, but the goal is to really maximize the value of the business because it's important for them to be working on something that is continuing to grow in value and that they enjoy and all those things. It's something that you did successfully, which I don't think all founders do. I think a lot of founders I talk with are very good at going from 0 to 1. They're very good at like building something off the ground, but then when it comes to building a team, it starts to get a little bit more challenging. And so for somebody who's listening that's maybe in that inflection point, how did you kind of like bridge that gap from just going very small team, building more systems and kind of your hiring, all those things that really helped add additional value to the business, kind of as you leveled up. So like, I'm really curious what that looked like for you and how the buyer perceived it.
Like you said, outside of the acquiring company or how attractive, I felt that the best bet that I could make was to run my business like if a financial acquirer was going to come around and look at it and say, like, how clean are your books? How clean is the operation? Who's doing what? And so there's some thought that goes into that. There's things like, what type of businesses are you focused on selling to? Do you sell to everybody, or do you sell on a more specific type of vertical focus? But that also starts to impact really good stuff. Like, we can all speak the same language as a team. Our marketing and our product marketing is talking to the same individual. Using like a grocery store example, you could be like, we've got a deal for consumers, but like, what is a consumer? If we just say like, people who want to make pasta, we've got 3 pasta sauces, or like that starts to get more specific. I think that's probably like a little bit of a simplified example, but people running SaaS businesses, I think when we start, we are happy to get any type of subscribers and customers that we can with a credit card. But we find ourselves having to start to talk to all of them at once, and our marketing and our merchandising starts to get complicated. So that focus not only impacts our customer relationships and the total addressable market, but it also does like soft skill type of things like, hey, this copy's good. You can talk to your marketing team and say, this is effective. This is talking to the right audience members. What that's ultimately is like a very clean, updated, up to date go to market strategy that says this is who we talk to, this is what we do, and this is how we'll win as a business. But again, that does end up becoming valuable because you can explain where your business is headed to anyone that's willing to listen, like an acquirer. Internally, it gives everyone an idea of what are we doing as a company and where are we headed. Now, once we've been able to do that, we can start to set goals, broad goals, high level goals, like we all do. Like, what's our MRR growth target for the year? What's our churn target? How are we going to get new customers? But we can also start to set, downstream with other members of the team, have them, what can they do to attack those goals? That's all based on how we've talked about we're going to go to market. And this is how we're going to win as a company. Once we start to see team members succeeding in that way, we can take that as far as it goes. I think one of the challenges that founders we tend to have is like we have a lot of stuff in our head, and it's frustrating when people don't have the same thing in their head, but I think that's unfair. So let's get it out of our head. Let's let our team succeed and slowly work on expanding that. To answer your question, as we're doing all of that, it makes the business a joy to run. We see other members of the team succeeding and doing meaningful work. We get to give really positive feedback, like good job. Highly powerful, highly motivating when people know what a good job is and we get to tell them. Frankly, as the owners of the business, we go from being more frustrated to having more clarity and having, breathing fresh air in your business. Tell us a little bit about how a distressed founder or someone who wants to get out can impact the value of their company, right? This isn't churn and MRR. This is like very like personal, emotional stuff. But John, when you see people coming to you that maybe are a little burned out, how can that impact the value ultimately of the business or the types of deals that they're able to get?
Yeah, so distressed deals, and when it's distressed from the founder's perspective, emotional can still do very well if the business metrics are okay. I think the flexibility plays a major factor into that when somebody's looking at potentially selling their business and they go to market and they are just totally burnt out. It's not an ideal place to be, but it also expectation wise, they're open. And so I think that usually allows for more creative deal structures that helps everybody win versus talking to somebody who's like, my business is worth 15 times ARR right now. I'm not going to sell unless I get, that number. And that's totally fine if that's where you would like to value your business, but it just makes it a lot more challenging when you're not receptive and open and flexible to how a marketplace will view it. Other buyers who are looking at your business slightly differently. So from my perspective, it's just positioning it in the most accurate light that the business actually is in and trying to be transparent, because if you're not transparent up front, typically that comes to bite you later on during the process. And that could be transparency around why you're selling the business. That could also be transparency around the health of the metrics and the customers and all those types of things. Buyers are risk adverse, skeptical, and so they really want real answers to why you're selling, what is really going on in the business. I think what you tapped on though was something I'd love to chat a little bit more about, which is strategy. Like a lot of the businesses that we see are scrapping together MRR from anywhere they can get when they're starting off, which is totally how we were as well. Very horizontal in nature. In our case, it was serving restaurants, retail, hospitality, travel. It was a bunch of different industries, and we struggled along the way to really define who we were selling to and for and why and all those types of things. Because of that, I think it also made it a little bit more challenging to stick out as a great target. And I think if we would have settled on one of those niches and really gone deep and solving those problems deeply, like this is not new advice, but I think it's just really hard advice to take. I think if we would have done that, we would have actually been more appealing to a couple of different segments of buyers. We can talk about those different types of segments that I see. Roughly speaking, we're looking at individual buyers, holding companies, and private equity companies. So I think realistically, when we were looking at the sale process, we were thinking a little naively and saying, "Oh, it's going to be a strategic buyer. It's going to be a competitor that just buys us for a customer base that is already venture backed, and it just takes out a customer, and then they have additional search engine rankings because they've taken out a competitor." But I think realistically, the most optimal buyer for our business, our B2B SaaS, was probably somebody who was a vertical based B2B SaaS acquirer and was, specifically in, let's just say, restaurants as a category or retail. When I look at a lot of businesses today, if I see a ton of horizontal stuff, if I see, one big customer in a random category, one-off revenue kind of things, or not a really clear avatar or clear market, that is very challenging. And it's hard because from a founder's perspective, and when I talk to people, they're like, oh, we could use this for anything. We could serve anybody with this. Anybody who needs a customer loyalty program, anybody who needs scheduling software, anybody who needs this. We could serve the TAM is infinite. And I think what's actually more appealing to most of the buyers that I'm speaking with at the call it lower middle market and mainstream market size is like, no, actually niche and like specificity actually matters. And really solving a problem, a niche problem very well, um, is actually more attractive, because typically you're going to see better retention in those cases. Typically you're going to see, um, you know, a better use case for the product. And so those are things that I would consider. I know you and I talked about this offline as well. Like you guys had to make a call on a big customer you had where, right? I think there were some stories, some backstory around something that you guys did positionally. Um, and it's hard calls for founders to make, but I think those are the types of strategic calls that can really set you up for an exit in the next 2 to 3 years.
It sounds kind of harsh, but like we've all done this and we say like we could serve anybody, or like there's like this hypothetical future looking statement. And the harsh comment is like, well, if it was possible, why haven't you done it? And if we take that a step further, there's kind of this idea that like, what business do you think is more valuable? The one that's like hypothetical and potential, or the one that's actually achieving it? I'll talk to folks in my work and they'll say, well, we haven't done any marketing. And if somebody acquires us, they could just do marketing and the business would be a lot bigger. That kind of somewhat harsh question emerges is like, well, if that was true, well, why haven't you done it? And there is often, in particular in our area with bootstrapped businesses, there is a concern of resourcing. And I think when we find ourselves as founders saying those types of statements, about we could, or we could serve anybody, that does make it more challenging. And if we put our feet in the shoes of a highly discerning financial buyer, they want to see something that's got pretty clear trajectory, that they can then put a financial model again, not some kind of strategic thing that we maybe have seen in the movies or in the press or something. The more that we can demonstrate it having been done and having a very clear, repeatable, almost predictable future looking earnings, let's say, to our business, that bodes very, very well. And in a clear, more of a vertically integrated or niched business aligns the whole business towards that. But we sell data subscriptions, but occasionally we'd get inquiries for us to do custom work for them. And early on, we'd say yes to that. By the end, we no longer did anything. We just sold the software subscription. At one point, we had one of these custom data contracts that was like almost, I think it was half of one of our team members' like salary. That team member in servicing that contract was not helping the business. It was a totally unscalable thing. The work that they were doing was not aligned with our strategy. I mentioned earlier, like it's easier to say good job when something's growing the business. It's, as a leader, I find it harder to say good job when it's just like the basic stuff we do. So this team member was like doing a thankless job on something that wasn't exciting, wasn't helping them grow their career. In realizing this and seeing, well, we can replace that over time just with our MRR growth, and we could probably do it faster if we weren't burdened by this contract. We told that customer we're not going to renew. The team member on our end couldn't believe it, particularly when he said like, yeah, you don't even like working on this anyway. Like, let's do stuff that you're motivated by. We never looked back on the expense, like the income versus expenses is like that, like looked more concerning than it was. When you and I see businesses for sale, like one-off ad hoc revenue sources, it's not worth anything. No one's buying us for that. That's a really kind of acute example. I know I'm kind of making it abstract to not be too specific, but that's a very specific example. But anything that's similar to that helps focus on our core business makes us more valuable. And I said at the beginning is I want to think in terms of value versus income. So we deferred some of that income because we knew we'd get it if we grew our business, and that's what ended up happening. And from a valuation perspective, it would be irrelevant at any time to just have a random contract that the buyer's not going to want to do custom data work that they don't even know how to do.
Just get into some of the meat of what we're trying to talk about today, which is around like the state of the market. And I'll just share some observations I've seen top level. Would love to hear your feedback on this too. So when we're talking about acquisitions, kind of in that 6 to 8x or 6 to 8 figure range, most of the buyers, like I mentioned before, a lot of individuals, holding companies, and private equity companies, and a lot of the folks that are going to be making offers on these deals are really looking at a handful of key metrics. Lifetime value of the customer, retention plays a huge role in this. What types of contracts do they do in terms of, is there a high level of customer concentration in large contracts with smaller customer or with larger customers, or is it made up of a lot of smaller customers with lower average revenue per year? And so it's the interesting thing to me is that it's not necessarily like a one size fits all for when it comes to valuing your business on these things. It's a very hopefully a keen understanding of the market that you're in, what are benchmarks within that market, and does it fit within somebody's thesis? Like, does it fit within a private equity um, thesis? Does it fit more within a holding company thesis? And by thesis, I just mean what they're trying to get in terms of returns. What is their timeline and horizon for those returns? And what is their strategy for growing the business over time or holding the business over time? And so those are kind of the major questions I'm asking is I'm trying to understand the market that they sit in, who are the major, the most likely types of buyers that they're going to see, and then what types of metrics are most important when it comes to those to that category and that kind of shape of a SaaS business. Yeah, broadly speaking, I think that's kind of what I've seen when it comes to businesses in this size range is it just needs to fit within some of these categories that really align with the narratives that are individuals, holding companies, private equities, and this is kind of like I'm just using these buckets because and there could be slightly different variations of all these things. I'm using those buckets just to give somebody who's listening or watching an idea of what that looks like and what the
Do
buyer can
you
look like.
find that, or do you recommend people have that broad bucket acquire in mind as they run their business?
I think it's a great exercise to do. And if I was to start again, what I would do is have an executive summary doc that I essentially write my own. And when we go to market, we have a confidential information memorandum. It's called a SIM, and there's an executive summary that's anonymized. You could have this be, something that's actually not anonymized for yourself and for internal team, but it's just be a great way to identify who are you for, who's the most ideal target for buying your business, trying to shape it from the end in mind. And that really, that is all that's going to include is here's the market that we serve. Here are the kind of customers that we attract. Here are the growth opportunities we see. Here's kind of the history of the business and where it's headed. And then those kind of key metrics I talked about are always sprinkled in there just to help people get context around what type of a SaaS business is this. I think it's really nice to start with a picture of the buyer type that you could be attractive to, how they value businesses typically. Or do they usually use EBITDA multiples or SDE multiples or revenue multiples? What types of opportunities might exist in the next 2 to 3 years if you do exit. So I love to start with that end in mind. In the past, like I said, when I was building my own SaaS, my head was down. I didn't really think about any of that stuff. I was just like, well, we're just working on this business. And I didn't think about an exit at all. And so I think it is important though, if you want to think ahead and try to position the business, it's good to reevaluate that as your business grows too. Like here, we started off as a horizontal solution, then we pivoted into this area. Okay, let's revise that doc. Let's come back to that executive summary of what are we about? How is this positioned for the right buyer? That way, when people are reaching out to you inbound too, you can kind of filter out the ones that don't make any sense. Like we got a lot of inquiries from, let's say, growth equity, who their playbook is more, we're going to take a minority invest. Well, not all of them. Some of them will do minority investment, and they will try to sell the business in 3 to 5 years, and you're going to operate that business. You're going to continue staying with the business for the next 3 to 5 years. You will take some chips off the table, and then you'll eventually sell with them. And so I think if that is if you're good with that, if you want to stay on with the business under somebody else's leadership and you're comfortable with that type of a scenario, then that's fantastic. I talked to some founders though, and they're like, I would never work for anybody else. I don't want an investor. I don't want to have a committee that's kind of making decisions for me about when I'm going to exit and what that's going to look like. And so I think building that executive summary is it can be a very personal thing, and it's designed not to just be a catch-all for something super generic. It's supposed to be aligned with like what. And then I talked to other people who are like, I don't really care who the buyer is. I just need to clear this amount. And it's like, okay, well, great. Now let's just talk about who's most likely going to acquire at that amount, what type of multiples they're using, and what are the key metrics they're looking for.
That has got to be most people. Like they have like the walk away, the number in mind. I approach it a little bit differently, and I didn't do what you. Neither of us had like a executive summary in mind. Again, I think I would encourage folks to start the relationship with John or anyone else that has kind of access to the market sooner than later. So my first mistake is I thought I needed to like have some very very focused decision on like, am I selling or am I holding this forever? The mistake is you can be flexible in that. And I think what's more important, running your company, owning this asset, is having access to better information and better guidance. You're an expert in your business, and there's other people who can help be uh, really good resources on what's possible and what's out there. Second thing that we did do is we had a really good idea of our kind of like our personal goals. Like, why are we doing this? And that can kind of even supersede, do I want to sell this thing? Because if you say, I like working for myself, I like my pace of life, this fulfills me, I feel proud by it. Like those are all valid reasons to do it. There's the part that you touched on is like, here's the financial goals that I have in mind. That's really important. So now we've married why you're doing this, which can help define what deal structure might look like and for how much. And then we look at like, well, what's the business need to do in terms of that niche focus and who our target audience was. All three of those things, none of them are more important than the other. They're all equally really critical. And without any one of them being fully fleshed out and thought out, it's kind of like a stool. If those three legs, if one of the legs is wobbly or isn't there, it falls down. And so I think putting our businesses in the best possible position is we know what we want, we know what we want from it, and we know how we want to operate it. And then getting a sense of where we stand today, it provides us with the idea of like, well, what do I need to do moving forward? The mistake we all make is we're going to heads down work, and then one day someone's just going to offer us 10x revenue or something. We need to be running a clean business. So when we think about what you're seeing today, you had kind of talked, there's kind of two categories: is the horizontally focused business that's making some money, and then there's more the vertically integrated companies that you feel have more value. Where are you seeing multiples today for that financial buyer, the more realistic kind of our audience can listen to and say, okay, here's where valuations are, what people can think high low in terms of what they'd expect?
Like the ballpark ranges that I usually share with people at the state of the market today are kind of if we're looking at the smaller end of the deal range, call it 6 to low 7 figures, is primarily usually driven off of discretionary earnings of sellers, which is like owner benefits in there too, because they're traditionally just smaller businesses. And a lot of the cash flow from the business just trickles to the owners. And so we use that as a base typically for a lot of the smaller businesses. And those can range from, 3 to 7 times, potentially higher than that. As a business grows in size, then you might use something more like EBITDA and more operating costs involved. And EBITDA is traditionally just going to be lower than your SDE, and because you're not like adding back all these owner benefits, and so therefore the multiples are going to be slightly higher than that 4 to 7 range most likely. The size of the businesses are also typically larger because they just have more of an operational overhead to them. And then where you hear about like revenue based, kind of SaaS multiples, it's usually typically dictated off of a couple of things: category and then the growth of the business. So when you're looking at a revenue multiple, you're projecting future earnings. Like that is the whole idea behind a revenue based multiple. It's not just because it's a software company, it's because investments in R&D or the growth of the business is kind of at a compounding state where those earnings have not yet been realized. And so that's the idea behind using, a revenue-based multiple. It doesn't really make sense to use a revenue-based multiple if it's highly profitable and not growing, because the earnings are already being realized and it's kind of just doing its thing. But if it's a revenue-based situation where high retention rates, it doesn't necessarily have to be verticalized, but I just tend to see better retention in those verticals that are boring, honestly, just things that, highly niche. Those tend to do 3 to 5 times, revenue multiples today. Could you be above that? Of course. Could you be below that? Of course. And growth plays a large part of this, and also deal structure plays a large part of this. Is like structure is not something we talk about a lot. It's highly variable because what goes into a multiple is not always consistent. Like if you hear a multiple from me today versus you hear a multiple from what Tom told you he sells his business for, or you hear a multiple from a strategic acquirer or whatever it is, we don't really know all of the details that go into a multiple because I'm not privy to all of that. That's in the purchase agreements. But the deal structure could be anything from like equity rolled into the next company. How do you value that? That could be earned out. Sometimes earnouts can be another 1 times of the multiple. And is that considered, part of the value of the deal? Maybe. What about employee agreements or employee arrangements? If you're paid to stay on, is that a part of the multiple? If you're paid a couple $100,000 a year for a few years, like, is that considered a part of the multiple? Yes or no? And so I think it's really difficult around these conversations because you can talk to somebody and say, I'll only sell my business for a 7 or 10x or whatever it is. It's like, okay, well, what if they make you earn it out over 5 years? Would you be okay with that? And if they're like, yeah, absolutely, then it's like, okay, that might actually be super achievable. But if they're like, no, it's got to be cash up front. I want to be exited in 30 days or, whatever it is. I'm like, okay, like I just don't understand how we're going to get there given the current metrics of the business and the expected returns of these people that have raised money that need to make money on these things. And so it just has to make sense, I guess. And that's why the conversation is so fluid and why multiples are so difficult and they're so personal to each company because the goals of the founder, and the business and the health of the business all kind of play a factor in those things. And it's really difficult when you kind of get into things besides just the multiple, the headline multiple versus what all went into that. What was all included in that.
As I said, I mean, when people come to me and are looking for advice and guidance and working together, one of the most important pieces of information that they can have is what is the range of values of my business and where am I today? Where do I want to go? That sets up discussion and the plan dramatically differently than I want to sell for a lot of money and I want to deal cash on close, walk away. The earlier that they can get just even a basic kind of just a general idea of valuation from you, John, or anyone else. I mean, there's companies out there that do it to help set the table for what their plan is, gives them that chance to then say, if you don't like what you're told, that's totally cool. You can work towards it. And if your goals are a big number, cash on close, walk away, once before the ink even dries, that's your prerogative. You can be told what you need to do to get there. And fantastic. Where it's much more challenging, as you just said, is someone's like, I want to do this in 30 days, or they're feeling like it's just much less realistic and giving yourself that time. So talk to John and get that valuation, and then talk to me and we'll work on getting you there. One of the things on the SDE side of things, how do you feel about kind of juicing up earnings and that strategy of starting to really reduce expenses at a given point in time? And do you see that happening? That's kind of one of the questions that I'm very anti that. I don't think that that's a good long-term strategy, and it's not sustainable for the owner because now we have less resources to help us with our business. But from a value standpoint, do you see that being effective?
I can be. It depends on the scenario. Here's an example. Let's say, for example, you are getting a certain rate from AWS with, just kind of ad hoc pricing, but you could do better if you did reserved, and you want to sell the business. You're not going to receive the benefit of kind of how that trickles down into the bottom line and a multiple on those dollars. You're not going to see that unless you make those changes and see those apply. And so you could say that's kind of juicing the EBITDA or juicing the margin or this or that. But I think like some of those things that you could do on the margin side could actually be very useful, because what we could do is say, look, now that we have 3 months in place of a reduced cost of cost of goods essentially on your hosting costs, you can retroactively look at the last 12 months and apply that, because for the future owner, that's going to be lower. So there are some circumstances where I think it actually makes sense to make those operational improvements. But if you're just talking about slicing things that are kind of critical to the business, whether that's team or resource, other sort of tooling, that's always going to be found out at some point. So I definitely do not recommend it, and it makes the business more difficult to sell. The investments I think that are probably even more important to make, if you can make them, and adjustments you can make are, let's just say, for example, you've been paying somebody internally and you've been overpaying them because you just want to have somebody always over, looking at this stuff, and that, but you haven't made the adjustments to find somebody better or whatever it is. Those adjustments can actually play out again in the same way. If you make the tough calls, you make the adjustments, you work through the risk, you should be rewarded for that, right? Like the risk that you're making those adjustments. Let's say a customer service rep, it's a friend of yours and they're overpaid or whatever it is, and you don't really need them, but you also don't like want to go through the energy of hiring somebody new and all that kind of stuff. But if you can make those changes and you could show them on the profit and loss statement, those do actually that is useful in terms of add backs and thinking about adding value to the bottom line that could be multiplied against. And so I think it's strategic thinking around that. I don't think it's just like, hey, we're going to cost cut everything and just try to juice up our earnings, but it's thinking about, if you have 6 months, if you have some time, put some of this in place, make the adjustments to improve your costs, make the adjustment to lean up if you're not using some of those things, and then be very deliberate about explaining your thought process around those things, so that when the time comes and you have to explain it to a buyer and they're looking at all of your books, you can say, oh yeah, we switched to reserve in June, and we saw the cost cut, and now the business is 5% more, 5% more gross profit than we were getting before. But we didn't do that initially because we weren't even sure if we wanted to use AWS long-term or whatever the reasoning is. Yeah, juicing it, I don't love that. But again, if it can be strategic and smart, I think.
But you get an opportunity to explain it.
Yeah, definitely an opportunity to explain it, and not just like, you're not just trying to. I've seen this actually, and another example of this is an increase in price recently, and that'll juice up your growth or juice up your earnings for a little bit. But then if you look into it, you dig into it, you're kind of like, oh, is this sustainable? What is the churn on these cohorts looking like? And so if you're going to make like as an example, a very practical example, if you're going to make a pricing change, you're going to want to see that flesh out over a couple of quarters, not just a couple of months, to give buyer more confidence that that move was not just a way to juice your revenues and your earnings. And so sometimes I've seen that when I look at it, I'm like, we should not go to market until we see how this plays out, because buyers will be very skeptical about the retention around these things. And now that's also a lever that they can't pull. And so they have to kind of think about, how that's going to affect them in the future.
My expectation, and I'm not on the buy side at all, John, but is like, when we think about COGS, is like, if I saw 15% in a SaaS business, I'd view that as like potentially opportunity. Less than double digits, closer to 5% would be, I'd try to be operating there. I think like someone who's got significant ops experience would be able to say like, oh, I think we can cut costs on, like you said, going from hourly to reserved instances, or getting more savvy on our server costs on the COGS side of things. Even before I even go there, I might be looking at the P&L and saying like, how this thing is itemized, there's clear room for our improvement just based on best practices of the financial documents. I think what I'm ultimately doing is leading us into a conversation about what business owners can do to be prepared today, in some of their documents, operating procedures, and so on and so forth. But if COGS is 9% of sales, like, that's okay, that's good. Or if it's 20%, that might be something either might be miscategorized, or there might be room for improvement. Do you see How do you see that in terms of just helping businesses prepare without even have to changing their costs because they now know?
Yeah, that's a great question. I think it really gets down to some sort of awareness around benchmarks and shopping around a little bit in terms of what you're currently doing, talking to other SaaS founders, talking to folks like myself who look at profit and loss statements way too much, like all the time. You can kind of pick up on those if you have a sense for what other businesses are doing. If I see something that's like, oh, the cost of goods here is really low, it's like abnormally high, and it's like, oh, they just don't apply the same type of accounting practices as other places would, and those costs are hidden in a different category. And so I think it's good to just have an awareness of what's going on with all those things, and if you can position those line items in a buyer's mind in terms of opportunity or risk, whatever it looks like, I think that's where it is important to talk to an advisor, because you can say, all right, buyer's going to see this and they're going to actually look at this as an opportunity to reduce costs. So that's going to actually, bode well for them. Or this one's we're already so tight on margin. Like there's no way to improve this, and it's not growing that much. And, so how am I going to make the money back? And so those types of questions are really good to go and look at your books and understand what's really happening, and try to get some sense of where benchmarks could be for your type of SaaS business. Same thing, it goes around churn and LTV and all those things. Like I have benchmarks that I kind of use in my brain and I think about, but I also give flexibility when I talk to the sellers about, or the owners of these businesses, like, oh, it seems a little bit high from what I've seen, but explain it to me. Like what maybe I've missed something, or maybe this is a case I've never seen before. Can you share a little bit about why your retention looks this way? And they might say something like, oh, well, like the churn actually in our overall business is 10% or 8%. But when you actually look at, the 50% of customers that are bringing in the most revenue and is growing the fastest growing segment, the retention there is like X%. It's like, oh, interesting. If I was just looking at headline numbers, or you're plugging that into a calculator, your valuation would be way different than if you're breaking that out on maybe a plan by plan basis, or having an understanding of what's really happening there. So I think that those types of things are really important for you to do the homework on, with or without somebody, just to understand like how is this going to feel to a buyer when they look at it. And I think getting really specific, the biggest things there is like cohorts, by plan, or by new people that are coming in, understanding what the metrics look like for those different segments or avatars, or whatever it is, to explain um, the metrics at a finer detail than just like the headline numbers. So that's not going to apply to every business. Sometimes they just have like one plan, and and maybe they've run like a lifetime plan or something like that, and they're like, oh, okay, this is actually not great. But I, a lot of times there's more nuance in there that is not necessarily just covered in top line numbers from ChartMogul or ProfitWell.
Yeah, most businesses aren't going to have the plan they started with, and they'll have legacy customers on it.
Yeah.
Is the business, is the plans that they've got today. There'll be a lot. There should be a lot more than that, just as part of the evolution of the company. It occurs to me there's kind of like if your best cohort, the closer that best cohort and its MRR, its percentage of business, its churn, the closer that cohort is at parity with your overall P&L, the better you're getting in terms of that vertical integration that you and I were talking about. We, as SaaS founders and starting to build these businesses, I think for me, and what I see is we lean very heavily on our like ChartMogul or our Stripe dashboards or Baremetrics dashboards, and less so on kind of the boring financial statements. And that's part of the maturing of the business, because in order for us to effectively communicate what we're doing as a company, it needs to be in the common language. It does end up starting to create, it's kind of like in the Matrix, like when they first show it, it just looks like all the characters, but then Neo can see it, read it or whatever. For business owners, tends to, you actually able to see your business through those financial statements after you've started to get more familiar with it, think about your business in those terms, and it impacts stuff like hiring orgs, bonuses, what you're doing as a business, where your opportunities are. And lastly, on that point that you made about like cohorting, that's kind of the initial beginnings of putting together that growth plan and that go to market rather than overall MRR. It's like, where's our best opportunity? And so when I talk about being a value advisor and thinking more in terms of value than income, well, you could get $10 of MRR or you could get $5 of MRR. But if that $5 is worth like double or triple than the 10, now you'd rather have the 5 than the 10, if that makes sense. Because it's just the turns on it, because it's just more valuable to an acquirer, is worth a lot more. And I think that gets us as owners excited when we're able to think in those terms. But that's not how we start our business. We just are looking at kind of MRR or ARR right away versus the nuance of it. People kind of wonder, like, is now a good time to sell? So what, 3 to 7 SDE, 4 to 6 revenue? Like, should we sell now? Should we wait? Like, do you have a sense for timing the market, or like, when's the best time to talk to you? I think I've already said this is right now. I would recommend everybody that's listening to get in touch with John, but how do you view it?
Yeah, there's a couple ways I look at this. One is you can just say that the best time to sell is, when you're ready to sell. You can say the best time to sell is when the public markets are high, because those tend to trickle down into private capital markets as well. But I think there's also just a level of a wash in terms of what your net return is going to be. And if you do that, like let's say we're still at the height of the market, then it's like, where are you going to reinvest all that money? You're most likely going to diversify, and then you're not buying at a low, you're buying at a high. And so I think it's really difficult to time the market. And so right now, what I'm seeing though is a significant amount of buyer activity. And so I can tell you that there's a lot of people looking for deals. I think this is partially due to just new year, new administration, lower interest rate environment. So overall, it feels like a great time to potentially sell the business. But I think also if the business health is not strong, I would probably wait. I would try to find it, if you have the heart to go the distance to improve the business. I would wait until you have some of that worked out. And, we can definitely come up with a plan with that, whether that's with Tom or with myself or whatever it looks like, to try to help improve the business, versus just going to market when the business is heavily plateaued or declining, or really struggling. Great businesses right now are going very quickly, and a lot of people are active on them, and the struggling business, distressed, types of things are still selling at lower multiples. Everything in between from the last, I would say, 12 to 18 months has just been really challenging. Everything kind of in the middle has just been crushed in terms of being able to move them quickly, or find buyers that are willing to take the risk. It's a highly personal decision, but when it comes to the overall markets and the buyer activity that I'm seeing, I'd say now's a great time to consider it if you're in a decent spot. And then the other time, and that would be really interesting to consider selling, is when you're hearing activity of other businesses in your vertical getting scooped up. And so that is paying attention to what's happening in your industry. A lot of times what happens, if it's a private equity company buying your business, they will buy what's called a platform business. Let's call it 10, 20 million in ARR. And then they will buy other businesses to grow inorganically by, buying their revenue and bolting it onto theirs. And now that, 10, $20 million ARR is worth more because they've acquired your revenues. And when they sell the business in 3 to 5 years, then the overall value of that grows, because multiples tend to grow with the size of the businesses as well. Those opportunities can be really fantastic because somebody has raised a fund of capital that they need to spend to get a return in a very, defined window of time. And so the multiples are not as, there's a little bit more margin to play with there, because people really need to get deals done. And so I would be looking at that as a great time to sell. Is, hey, I just heard so and so got bought by this larger business, and we integrate with this company too. So they actually might be interested in us. And oh, there's another competitor that just sold. They might be interested. So it's like, I think those are the ideal times, is when you're starting to feel the heat from industry players that are being acquired by private equity backed owners, that to me is another really great time, because the multiples might not always necessarily be drastically higher, because again, there needs to be some sort of arbitrage, multiple arbitrage. The deals are most likely going to be more flexible and faster, more certain, all the things that are super important to me when I'm thinking about which buyer do we work with. So those would be kind of my, I know this is a really long-winded answer, but that's kind of the way I'd be thinking about things when it comes to timing the market.
I tell people, like, we can't, just like the stock market, we can't time it. And this is even less liquid. Like, there's just, the marketplace is much smaller, and it's very hard to predict. We don't have to have a single game plan forever. So like, we can revisit this. I didn't know that when I was running my company. I felt like it was really important to like say I'm never going to do, or I am gonna, like, I'm definitely going to do, put the business up, or I'm never going to do it. And I think that that's a mistake. I think that as a steward of your company and as a leader of it, having access to information, again, I would really urge folks to get in touch with John to just start that conversation and see where you are. There's no obligation. That gives us as owners the ability to say, okay, here's where I'm at today, and here's the range. What we do have the ability to control is not the time, but where we fall in that range and what we can do operationally and how we can position ourselves to be in the best spot. If that aligns with our goals that we've set, personal, financial, and the business side of things, it might be the right time. And you can make that decision and start to push much harder. If those don't align, you now can put together your business plan to get you there based on whatever conditions there are at the time and continue to drive forward. No matter which decision is made, you're still aiming to run a very sustainable, fulfilling, awesome business. And so that's what I think is there's, it can feel overwhelming. The other thing is people talk about the deal. They talk about talking to like an M&A advisor like John, and it's like, you're going to be taken advantage of. Well, if you're clear on what your table stakes are, you have the power to get what you want, and you know what you want. And I think all the little nuance in the deal side of things, the nuances that can be really overwhelming, that anxiety goes down when you know the big picture and you've thought through it. That's irrespective of market timing. It's really about what you want, and ultimately, I think that that's possible. Is you can say, I want to grow past 1 million ARR to get a better deal. John can kind of touch a little bit on this, but like the size of your company as one of your goals does help you to kind of think about where you might fall in terms of different bands, and revenue might be a part of it. Well, put together that what your addressable market is, what you think you can capture, and how you're going to do that, and then go do that. And so I think that that gives people a little bit more flexibility in terms of what's the right time, is you've got a plan and you're going to go do it. So as people think about the state of the market today and some of the valuations that John talks about, what's important is to get in touch. And John can walk through a little bit about what that process looks like. Get in touch with John and think about the valuation and the range of high-low values for your specific business and potential next steps.
Yeah, so if you're thinking about this, you want to dig in deeper, and you want me to take a look at the business, I'm happy to do so. A lot of this is revolving around your SaaS metrics, which if you don't have those already in place with a tool like ChartMogul or ProfitWell or Barometrics or something like that, there's a spreadsheet that we can provide to you to use along those lines to see how things are trending overall and by cohort and plan and stuff like that. And beyond that, it's mostly looking at your financials and understanding, how you're running the business day to day and the market. And so from there, usually it's a 30-40 minute conversation. It's looking at your metrics and trying to understand the business as best we can, and then providing you with kind of that high-low range and how you can improve that if that's your goal, or if you're ready to go to market, what that would look like. So I'm happy to have those conversations with people. From my perspective, it's okay. Like if somebody's just curious, that's totally fine to just reach out to us and get a valuation. There's no pressure from my perspective to ever try to, I'm never in the business of trying to convince somebody to sell their business. And oftentimes I'll tell people like, no, I think you should stick with it. Like, why would you sell the business? It doesn't make any sense. Yeah, feel free to reach out. I'm happy to help in any way I can.
And when you get that input from John and you say you want to grow your business because it's not at the numbers you are expecting, or even worse, if you don't actually even know what to expect and you haven't thought through your goals, get in touch with me. And I'd love to talk about how we can make the ongoing management of the business just as exciting as some of this acquisition and exit stuff. So thanks, everyone.